There are a few different ways to manage positions and look after your trades when you're already in them. One of them is stop loss trading, and that is what we're going to talk about today. I'm going to show you what stop loss trading is and how you can use it correctly to create win-win scenarios in your trading, which ultimately will help you to increase your total profits. So let's get straight to it. So what exactly is stop loss trading then? Well, when you get into a trade, you should set a stop loss order on every trade. So for this is our entry, this is our target, and this is our stop loss. Now your stop loss is going to get you out of a trade if a trade goes bad. But the bonus of stop losses is, once we place them, we don't have to leave them exactly where they are. We can actually move the stop loss order different ways to different prices. Now we should never extend a stop loss, because if we get into a trade risking, for example, $1,000 on this stop loss, if we double the size of that stop loss, we're actually now risking $2,000. So it's impossible to manage risk if you extend your stop loss that way. But what we can actually do is grab our stop loss order. So let's say this is indicating the stop loss, and we can pull it in to the entry price, for example. Now, if we pulled the stop loss to the entry price and the market went up a little bit, but then reversed on us, rather than taking a loss if the market got down here, we would actually be closed out of the trade at this point, which means rather than losing money, we would just be out of the trade for break even, okay? Which means we do not take a loss. It means essentially we've won this position in a sense that it didn't cost us money. Now, we can also move our stop loss into profit. Obviously, we can't do this if the market price is under where we would like to put the stop loss. But if a trade starts to move in our favor, we can actually utilize this ability to move stop losses by doing what we call trailing. So let's say this position moves in our favor up to this point, and then we start to create some new structure. What we could do in this instance would be move our stop loss up to follow the structure. So this way, if the market pulls back, finds a new low, and continues the trend, we can simply trail again. But if the market is to make a full-blown reversal and move all the way down here, rather than getting stopped out for a loss, which is not good, or break even and missing out on all of the profit potential we have in this area, we would actually be stopped out of our trade at this level here. Now, if we think about what that would do for us, well, our 5.5% potential trade would be stopped out here at 1.8%. Of course, we didn't get the full 5.5% that we wanted, but we've still taken a positive outcome on this trade, okay? Rather than making $0 or making minus 1%, we've actually made plus 1.8 because we trailed the stop. So stop loss trading is simply utilizing the fact that we can move stop loss orders and following price with our stop loss as the market moves up. If we do this, we can actually minimize the possibility of this trade turning into a 0% trade or a losing trade. And we can maximize the profits that a trade can provide us because we can actually close it as soon as it starts flipping on us. Now, there is a right way and there is a wrong way to trail your stop. If the market is moving up in your favor, what you shouldn't do is just run your stop up immediately behind price, okay? So let's say price moved from here to here. You don't want to just follow it directly with your stop, because as we know, markets rarely ever move perfectly upwards or perfectly downwards. Most of the time, if we look at smaller price action or smaller charts, we're going to have some movements like this going on, right? Which is, of course, likely to lead us to being stopped out by market noise on the way up towards the target. So because markets are prone to moving up and down, and we could get movements like this before the target is hit, it's important that we're smart with our trailing. The best way to trail stops to avoid the problems we've just discussed is to follow structure, okay? So structure refers to highs and lows in a market. Now, if we take a look at this market example here, let's say we have our stop loss in its initial position, we can mark structure up from high and low perspective. So this is our high. Here we have a low, here we have a lower high, and here we have a lower low. We have a lower high, and then we have the low, the lowest point, okay? So this phase of price action based on structure is bearish. That's a market that's moving down. In this instance, we would want to sell. The formation of the trade that we got happened after we had a break of structure here. So a break of structure is simply a point of which the structure breaks, the previous low, previous high breaks, and gives way to new price action. So this would be our break of structure on the downside, as with this, and as with this, where we're seeing the market price breaking consistently into new lows. Now I see this here as a break of structure into a new high. This is the start of an uptrend. You might know this as a change of character. For me, that's kind of pointless terminology. I don't use it, but that may be what you've heard of that if you've traded price action before, and you're confused as to why I call that a break of structure. Now, the market at this point is trending up. How do we know that? Here we have a high. Then we create a higher low. So this low is higher than the previous one. Then we create a higher high, a higher low, higher high, higher low, and so on and so on. You get the idea, right? So what we're actually doing is looking at the real highs and lows inside of the price structure. And this is how we're formulating ideas as to which way the market's going. Now, how is this relevant to stop loss trailing? Well, that is because we are going to follow the highs and lows in price to actually decide where to put our stop loss. With this initial move up here, we're not going to do anything with this stop at this point because there's every possibility that after pushing up, the market pulls back down and then continues after making a new high just above this previous one. So because of that, we don't really want to move the stop based off of the first price movement. Then we see this point here, the market pulls back, creates a new low, and then pushes up and creates a new high. So this high here validates the structure, right? At this point, we have had a movement up, a validated low, and a new validated high. The high and the low is validated when we get the break of structure. Our break of structure in this instance took place at this level here. The point where this high was broken by price, creating this new high, which validates this higher low. At this point, we could actually trail the stop to under this structural low here. The reason we can do that is because if the market is then to reverse and take out this low, we could be seeing here a change in the trending structure of the market. We've actually then gone from a market phase of upward higher highs and higher lows, and we would be shifting back into a new lower low with a break of structure under the current price action of the uptrend. This is then likely to be followed by a pullback and sell, which would generally lead us to losing or breaking even on the position. So basically what we're doing here is waiting for validation of a trend in this format that we've just discussed. Then we can follow price by putting the stop loss under the recently formed higher low. As you can see then, after creating this high, the market pulls back and creates a new higher low. This higher low is not validated until we create this high. When the market creates a break of structure over the previous high, just here, the break of structure being here, this closure up here validates the initial low, the low being this one in this example. So at this point, we could then safely trail the stop loss from here under this structural low to here under this structural low, because we know that the higher highs and higher lows of the market continuing up and up and up. And with the formation of this high, we've validated the formation of this low. And the market shouldn't really move under this low if it's continuing in its uptrend. All right. Once again, then we come down, we form a low here. This low is validated when there is a break of structure here, creating this new high. So we can actually pull the stop up to this level and trail it under this low. Now, if the market had then created a high, validated the high, and we trailed the stop, and then decided to reverse on us, so if we'd have had a movement down like this, we'd be stopped out here instead of all the way down back at our entry or at our stop loss. This means we would have created a profitable trade here of 2.2%, which obviously, yes, is not the full percentage target we want, but it is still a lot better than the trade going all the way back to zero or to negative. So that's the idea behind stop loss trailing. Structure is the one big thing we want to look at. And now let's go over to a chart and I'll show you how this looks in action. All right, so in this example, we are going to look at a trade on GBP AUD, which is a selling opportunity. So it works the exact same way for sells, except you are going to trail your stop loss over highs as the market structure breaks down. The position is just now executed. Our initial stop loss, our order to get us out of a trade in a loss scenario, is above this high. For now, we don't want to move it. We need to see some structure form before we can actually consider moving our stop loss. So we can look at the recently printed low. We need to remember though that until we close underneath this level, there is no validation of this low, okay? The market could realistically move higher, so we don't want to trail stops until the market's pushed under this low. Allowing the market to play forwards, we see we get a nice downward move initially. At this point, still no trailing would take place. Now, one very important thing about this trailing system is that you need to stay time frame relative. That means, for example, in this position we executed here on the 30-minute time frame, we don't really want to go lower than the 30-minute to determine the structure. Because as we discussed before, there is noise on lower time frames. If we execute on the 30-minute and then we go to the 5-minute, there is going to be trends inside of trends taking place right here, where I've just drawn this line. Which means we may be drawn in, induced to actually move our stop loss into profit, or trail it at least behind price, based on 5-minute price action, when realistically the market could chop back and hit those stops, okay? Such as, just down here, we created this low, we pulled back, and then we've pushed back up. If we'd have trailed our stop loss based on low time frame structure, we might be out of this trade, even though it still has all the room to move lower. So now that we've validated it and closed beneath this low, we can take the first step to trailing our stop. And that's gonna be nice and simple. We are just gonna pull it to the entry level, okay? This is now what we call stop loss to break even. That would essentially pull the stop loss all the way to the entry point, meaning if the market reverses on us, we will not take a loss. We will be out for $0, profit, $0 loss, okay? I'm gonna leave this to visualize the risk reward, but we've pulled the actual simulated trade stop loss down to the entry point. Now we are in a win or no loss scenario. We can also go ahead at the moment and start to look at the low that's just been printed, because if the market was to pull up and validate a high, by coming back down and breaking through this low, that would give us what we need to actually trail the stop down to this point, for example. So let's run it forward and see what the market gets up to here. Once again, keeping it relevant to the time frames. So we're going to be working with the 30-minute, okay? So as of right now, basically, as we understand, providing the market stays under this high, it is still in a valid downtrend, and we can happily hold the stop where it is without worrying too much about getting stopped out. And if we do get stopped out, it's generally going to be because the market is pushing up and breaking structure, which would invalidate our position. And at that point, we'd rather be out risk-free, okay? So we're seeing the market pulling down, and here we've created a candle closure. Our first break of structure was here, which allowed us to trail the stop to even. Our second break of structure has just taken place here, which would allow us to trail our stop down under the next structural point. That, for me, is going to be this wick area. I'm going to pull this over so it stops being annoying. We could pull the stop to just above this level. It's not too much further, but it gives us at least a small win in the worst case scenario if the market was to flip against us. Now, we would like to see, for continuation of this trend, a new high, followed by a new low, to validate the high, and then we could follow the market down with our stop. So let's see if that happens. We basically just want to see a continued downside. Generally, I look at structure as waves. This is something interesting as well. As to not get caught up in every tiny little move that takes place, try to visualize structure as larger waves. So average it out. That's wave 1, that's wave 2, that's wave 3, that's wave 4. This is wave 5. We generally want to see some form of meaningful retracement in order to validate this wave of structure and give us what we want to go lower, okay? So that's the idea of just averaging out the waves of structure so that you can, see them for the full picture. So now that the market's flattened out quite a lot, I'd be interested in seeing this structural low break. We could validate this as a previous structural high if we were to get some solid closures. So there we have a closure. We could go ahead and trail the stop loss down quite aggressively behind price. So now we'd see this as our next structure wave. This is the following one from there. This is where we're actually starting to turn this trade into quite a large one. In the worst case scenario now, we're probably going to get around 2%. Yeah, about 2% if the trade hits stop. But if it continues with the downward trend, we obviously have potential to take this into the full target. So allowing this to run forward a little bit more, we see the market come up. We are looking for a new low. There's our new low. So let's just run through price, remove these off just to keep it neat. We have the first break of structure that we covered, which is going to be this one here. So we created a low and we broke it, which allowed us to bring our stop to here. Then here we created a new low. We broke it here, which allowed us to bring our stop down to this point. Then we created this high, followed by this low, which allowed us to bring our stop to where it currently is. And now, once again, we have created a new break-in structure. So neaten that one up. We've now pushed through this 30-minute low with a nice candle closure, so we can bring our stop down to above this high. We're now probably looking close to 2.5 to 3% return in a worst-case scenario. And of course, we can keep running this towards the large target. Let's run it forward a little bit more with our trailed stop. We are hoping that the market will create a new validated low, lower than the previous one so we don't get stopped out, to keep that trend intact, okay? So ideally, from here, we would see the market start to flip down. We would need to see closures just like that to validate the next low, okay? Now, this isn't always going to be so smooth, and this is why trailing is a viable thing to do and a very valuable thing to do at that. In this instance, we have had a reasonably nice trending market, but markets aren't always going to go the way you want them to. This one could still flip on us rather aggressively, and that will sometimes happen. That is the whole reason that we do this trailing method. Because if the market decides to make a sharp reversal against us, at least we are taking a good profit rather than getting stopped out for zero. So what we can do now is put our stop loss above this high, and then providing the market doesn't make a new high and continues with the trending structure, we should be just fine. Now there's also another method of trailing that we can discuss in just one moment, around here. Sometimes you're going to be getting very close to your target. So our total target for this simulated trade is 7.7%. We're now at 6.3%. This means we have dynamic risk reward to consider. If the market gets all the way back up here, we'll be closing this trade for 2.6%. That means we're going to be risking close to 4%, okay, 3.7%, just to hold this trade out for around 1% more profit. So we have a dynamic risk reward problem where we're basically going to be risking 3% to make 1. Now, this is the only point of which, if you wanted to, at this point, we could accept, look, this is a very big trade. We've closed 6.4%. We can start to work with aggressive trailing. So remember at the start of the video, I said generally we don't want to just chase price down with the stop. It's a point like this where the dynamic risk reward is worth considering that you may want to do that. Now, there is also nothing wrong with leaving your stop loss where it is here. You could leave this and just let it run. Hopefully it hits the target. And if it flips on you, then you're still going to be taken out for around 2.6%. But if you are a bit more of a risk-averse trader and you are seeing that, look, we've got a 6.3% return here, I would rather lock in as much of this as possible. You could do aggressive trailing, which is essentially where you follow the individual candles down. So if we moved our stop loss to this level, for example, that would mean worst case on this trade now is going to be a 5.9% return, or pretty much a 6% return. You could also, if you wanted to give it a bit more leeway, put it above the previous structural high. So this would be our standard position to put it in. That's going to lock in a 4.6. Or if you wanted to trail aggressively, you could really follow price down. And basically on the formation of every new candle, you would essentially then just follow price through the range, okay? Now in this instance, because of the difference, this is already a 4.6 position. I would say just trailing over the previous structural high. It's probably going to be the best move here. And if we get a closure down here, then I'm going to get seriously aggressive with trailing the price. But providing the market stays under this high, we should be okay. And because we've now managed to extend the profit potential of this trade out to a minimum of 4.6, I'd be happy to give this little bit of leeway. If we miss out on this 1.5% return, that's fine. We're still closing in 4.6. And if we run straight down, perfect. We can aggressively trail behind price and bring things down to the take profit, okay? So let's see how the market goes. We see a small high being created. Ideally, we would see a push down and closure under the low. That would then validate new lows and we could get really aggressive with the stop trailing. Now, in this instance, of course, if the market reverses on us, we are not hurt here. We've taken 4.6% from a trade. So we're happy either way. Of course, the ideal scenario would be the rundown, but we will just see which way this goes from here. So now that we've started to push down, realistically, we would then ideally want to start aggressively trailing. This is a weekend gap, so this is just an anomaly. Sometimes that's going to happen where you get gaps up. For this trade, we have then been taken out for a 4.6% return. Realistically, we wouldn't be holding this trade over the weekend this close to the target, so it's more likely you'd have taken around 5.5% by closing it before the weekend started. But in a simulation setting, of course, it's easy to miss these little things. So let's take a look at this trade then. Pull this all the way across. We were stopped out just here. This creates a 4.63% return for us. If we take a look at the profits on a $100,000 account, this is a $104,681 balance. So that's a $4,681 profit on that position. Now, if the market was to reverse all the way on us at any point throughout this journey, we've basically built a scenario for ourselves where we are getting out for a win, okay? By the time we got to here, we were already break even. So just this first push removed all risk from the trade. By the time we got to here, we had a minimum of around 0.5% profit locked in. By the time we created this high, we were going to be looking at around 2% profit at a bare minimum. And we've actually managed to follow this all the way down successfully. But had the market flipped on us at any point, we'd have been out for a winning position. So we've created a scenario where it is purely win-win. Now we've been stopped out down here due to a market gap. Your more realistic close for a position is going to be around there. End of week, close the trade up and let it go, which would be 5.87, but even 4.6 is definitely something to be rather happy with as well. And that's a solid explanation of stop loss trailing, which is an excellent way to minimize losses and maximize returns from your trades. Stop loss trailing helps to minimize the risk of losing, helps to lock in profits, and creates win-win scenarios, which is quite a rare thing to get in trading. The simple process to follow that I've outlined for you in this video is once you've entered and your stop loss is under a low or above a high, you would then wait for validation of a new high to form within the existing trend, which requires a break of structure. That low being validated by the creation of a new high will then allow you to move your stop loss up to follow the structure. And again, the formation of a new high will validate the low, and then you can move your stop loss up to follow the structure. And the cycle repeats like this until your target is hit or the market reverses on you, but you still get out with a nice win.